just because it's nice to get your take on what you think is going to happen to the market in 2023. And yeah, what do you think?
We're quite bullish about it. We don't think there's going to be a crash. A crash is when prices drop by more than 10%.
Yeah.
And we don't think it'll actually reach that level. I think, it'll probably average somewhere around 5 or 7% correction, which isn't a big deal because they went up 20% in the last 2 years. So as we said earlier, so if you lose 7 out of the last 20%, it's not a big deal as long as you're not planning to sell, or as long as you keep it long term.
Yeah,
I think property is still a good place to put your money, and more so in the areas that you work, which is the north of England or the northwest, northeast.
northeast.
Where the yields are still better than London, because buy-to-let really doesn't work in London anymore.
Because of the what do you call it?
Yeah.
The stress tests and stuff, isn't
The
it?
stress testing, yeah, it's a bit of a nightmare. It's very hard to get 75%. So I think investors will turn to holiday lets, multi-unit blocks, HMOs, assisted living type scenarios where the yield is a lot better.
Yeah.
And I think the north of England will benefit much more than the south in the coming years.
So just to come on to that point that you said, you don't think it's going to crash, right? It sounds like when you open the news up, right, it's always like, oh my God, it's going to be the biggest crash in the world. I hear Robert Kiyosaki say the same thing. Oh my God, the biggest crash ever, bigger than 2008. Why? Why do you not think it's going to be like that?
Because rates are dropping, and there's no credit. There's no shortage of funding, which was the main reason for the 2008 crash. So the banks do want to lend, it's just that their hands are tied because swap rates have shot up. 5-year swaps are 3.68, I think, the last time I checked. So a good 5-year scheme is now coming in about 4.5%, which historically is still good.
Yeah,
it's just that we've been spoiled over the last 12 years or so with historically low interest rates.
Yeah.
We may not come to that stage so soon, but I can certainly see rates coming down to 3% next year.
Yeah, okay, that's interesting. Because and of course, the point you're saying is that as rates come down, we kind of start to even if rates kind of stay where they are right now, once everyone kind of normalizes that this is the new rate, then even at that point, people start going, well, I know that property is here for the long term. I'm investing now so that in 20 years' time or whatever, my house can be worth 3-4 times what it is when I purchased it. And as a result of that, I suppose people will, as soon as they realize that this is the new rate, they'll still keep buying.
Yeah, I think we just got to accept we're not going to get back to those rates. And as soon as we expect rates to be 3-4%, people will dive in, because at the moment there's a demand building up in the background where people want to buy.
Yeah.
But are sort of holding off their decision. Yeah. Because rates are quite unaffordable, particularly for first-time buyers.
Yeah.
So I think that sector of the market is waiting to pounce. And this morning, one of the lenders is cutting their 90-95% LTV rates. So I think whilst the 65 and 75% rates are superb, the 90-95% are still relatively dear. So as soon as that starts to go down. That's the signal for first-time buyers maybe to venture out again and start looking and locking into those sort of, half-decent rates.
And then let's talk about the opportunity then, right? Because what you're saying is that in the long term, you see that we're not going to go into a crash. In the long term, you see that rates are going to come down and stabilize around, say, 3.5%, whatever it might be. And as a result of that, and there's demand being pent up right now, just before just during the pandemic, when we were in lockdown, demand was pent up. And then after lockdown, it took us like a year and a half, 2 years to kind of catch up with that pent up demand. Now, where can you see the opportunity right now for this year? And I'm specifically talking about buying property as opposed to like where you end up renting them and stuff like that.
Yeah, I mean, the rental sector is busy. Yeah, there's such a shortage of property in London and other parts of the country that if you do buy and buy well, you can't really fail to make money on rent. The only issue is getting the funding, and that's the tricky part because of the ICR calculations. Being placed upon by the banks. So I think there'll be a geographical shift for new landlords. They'll sort of give London a miss in the short term and head up towards the Midlands and Northeast, Northwest. Wales, Bristol, those sort of areas are, particularly busy. Scotland's done well, as you know as well.
Yeah,
I think that's where the growth is for the next 2 or 3 years. I think we'll be in the higher yielding areas where buy-to-let still makes sense.
And when you say make sense, what you're suggesting there, just to touch on it, is that the rental cover still works. The stress
Yeah.
tests still work, isn't it?
Yeah, because people don't want to put down 50% or 60% as a deposit. They want their money to go further. So
Yeah.
the preference is always for that 25% to be just enough to actually get it over the line.
Yeah.
And that's not going to happen in the south. That can only happen in the Midlands and the north, where the yield is there, where you are still getting your 8 and 10% returns. Whereas, in London, we're struggling with 3 and 4% yields.
And then in terms of growth, capital growth, what do you foresee? Where do you see that side of things going? Because obviously, we're talking about, like, we had historically really low level of interest rates, but then on the other hand, we're saying, well, actually, when people re-normalize their understanding of the rates, bearing in mind that at one point they used to be 15, 18%, we're still very low. Are you seeing that the property market is going to continue to grow over the next sort of 10 years or so?
It will
Property
do,
prices?
yes. Yeah, I mean, if you look at the historical figures, after every recession, the property market has boomed. So, we are expecting to go into a recession, a mild one. And I think after that, things will normalize. And, the inflation rate obviously is still double digits right now, but that's expected to come down to 7 or 6% by the end of the year. And at that point, base rates should start to drop as well. So all this, I think, is quite temporary, and I think we just need to ride the storm. Yes, there are unknown factors, as you know, Putin and the war in Ukraine. These strikes for extra pay will slow down the decline of inflation, which is going to probably cost people more than the pay rise itself.
Yeah.
So, whilst I sympathise with everybody on the nurses, and they do a great job and they deserve all the money they get, if unrealistic pay rises are given by the government, that impacts long term on the public purse as well, because higher salaries means higher pensions and higher costs, and et cetera, as well. So there's a knock-on effect when these big decisions are made.
Yeah.
But yeah, I'm pretty positive. I think we're not going to see a great increase this year. There will be a price adjustment or a correction between 5 and 7% nationally.
Yeah.
On average. Some parts more than others, obviously.
Yeah.
And I think it'll start to move on as soon as we get base rate down to sensible levels again, and the mortgage rates and the ICR calculations start to work. Yeah, the market will carry on moving forward.
So it sounds like what you're saying is that by the end of this year, as let's imagine that now for the next 12 months or for the next 11 months at least, because we've had it for the last 3 months already, we see a steady decline, very slowly, but steady decline in the swap rates and therefore in the mortgage interest rates. As a result, we'll also see some perhaps reversal of these really high stress tests and maybe a decreasing in those, in which case people will start going, oh, well, actually, property might not be such a bad investment after all. Let's get involved. And so perhaps towards the end of this year, all those people that are currently not in the market will then get back into the market. In the meantime, right now, what we're saying is that there's people that are kind of like holding their breath because they're like, well, hold on a second, the news is telling me we're going to go into a big crash. Is the opportunity then for, sorry, and the last point is you said that in your opinion, you think that the market is going to come down a little bit, softened, and maybe by in the region of kind of 5 or 6%, 5 or 7%, but in that kind of region. On that basis, then, is the opportunity right now to get in right now at below 5 to 7%, so that even if it goes down by 5%,
absolutely.
you've saved that.
Yeah, I believe that to be the case. You need to find motivated sellers. You need to find out people who need to get out quick, and being in a good position to buy is quite important. So you've got to be ready, mortgage ready, cash ready, and have your tax advice as well, because because of Section 24 changes, it doesn't really make a lot of sense for high rate taxpayers to buy in personal names. So you need to open your company, you need to open the bank account for that company and be ready to buy in whatever vehicle your tax accountants advise you to buy in, because it's not just about buying the right property, it's buying it with the right mortgage and under the right wrapper.
And with regards to mortgage, obviously we're talking about here's the opportunity, and you said like being ready with the finance. There's two ways of doing this, and not for everybody. For some people, they have the opportunity of, say, buying now in cash, or the opportunity of, even though the mortgage rates are slightly higher, buying now. In fact, I was looking at this the other day, Bob. When we look at mortgage rates, if we look at the tracker rates, for example, they're still another 0.5, 0.8% lower than the fixed rate. So actually, if they wanted to, they could buy with a mortgage right now and then refinance, or they could buy in cash. Have you got a situation that you think is preferable in terms of buying in mortgage or buying cash? What do you think?
Okay, it depends on the individual. Most investors don't like to lock up cash,
Mm,
and if you do buy in cash, not every lender will let you refinance within sort of 6 months. There are some,
yeah.
but normally you'd have to wait 6 months to start extracting your money.
Mm,
Uh, you have to buy in cash if it's a tied property and not in a good lettable condition. So that's
mm,
good reason to buy cash and not have to borrow on a bridging finance, which you and I
mm,
know is quite dear. Um, but I think it depends on the individual how they want to use their resources, and
yeah.
buying in cash is good, but it doesn't. It's not good for gearing because you're not really making best use of your money.
Especially if we're
Uh,
saying that, the
mm,
opportunity is short term. Let's say that the opportunity is between now and, the quarter 3 of this year. Then actually, what might be better is to say, well, let me, instead of buying, one with cash, let me try and secure two right now whilst the
yeah,
going is tough in the market.
yeah. I mean, look at the auctions. I mean, the auction is a great place to buy because sometimes you can end up with a pretty good bargain if there's no real competition for that property,
Mm,
uh, and you can get a good price. But I think the tip is focus on one particular area and become a master of it because no one could master all of the UK and the microeconomies that prevail. I mean, obviously you concentrate in Leeds, so
yeah.
you know the Leeds market inside out. So
And know, and like you said, knowing where to put it. So we operate in Leeds and Sheffield, and it's really important not just knowing, when you say the micro market, what you really mean by that is which roads to purchase on and which roads
yeah,
not to purchase on. In fact, I say to people all the time, it's not even which roads, it's which side of the road
which
to purchase
side of
on,
the road? Yeah, yeah.
and
No,
not
no.
which side not to.
I mean, in London, that can make a big difference in some cases. So it's knowing that, having that extra knowledge, which
Yeah.
could make the difference between a okay investment and a great investment.
Yeah, and Bob, just to sort of round this up, in terms of mortgage advisor, people say, oh well, should I use a mortgage advisor? Because I can just go to, hopefully, Money Supermarket or something like that, God knows, and try and see if I get mortgage rate off there. And then there's the option of using a mortgage advisor, using, what's an independent mortgage advisor? Give us a bit more information on that and why people should bother using a mortgage advisor
Okay, I mean,
when it
just
comes
to
to
give you
buy
some
to let.
stats, that yeah, we're talking about buy-to-let and even standard residential
Yeah.
mortgages. I mean, we're here to help you. We act for you in finding the best lender and the best rate, because for a layperson to do this, it takes hours and hours and hours. The application process is laborious and complex. What we're here for is really to match your circumstances with the right lender and
Mm,
getting the right rate, right deal, right term, right product. Yes, we charge a small fee for doing that, which is a fair fee.
of
It's
course, yeah.
disclosed before we even start the work, but it's really saving you time. If you're time poor and you want expert advice, mortgage advisor is your best friend. Yes, you can go on the internet, you can look at the best buy tables and make direct applications, but you don't really get a relationship with an advisor,
Yeah. And
and
I
this
think
is what we
the
offer.
other, so on one side, of course, is saving time, but the thing that I've found most valuable with mortgage advisors is, and I don't even know if we're allowed to say this, Bob, but it's knowing what to tell the lender and what not to tell the lender, because sometimes that can make a big difference to you getting something across and you not getting something across, or you getting a better rate and you not getting a better rate. So first of all, it's about, like, there's hundreds of lenders out there. Which one do we use? And then it's which product is right for us. And then it's how do we actually get those products? And I think that last bit about the expertise of what to tell them, what not to tell them, to be able to get that rate, I think is really important.
It is, yeah. I mean, I've been in the business now 30 years.
Mm.
And so we've built up, good relationships with lenders, with the business development managers for those lenders. So sometimes, even when a case doesn't fit, we can normally force it through.
Yeah, yeah.
Yeah, because of
And
our
part of
relationships,
that, I was
etc.
going to say, part of that is because you have relationships directly with
Yeah,
lenders
yeah,
and the BDMs, isn't it? Yeah.
yeah. And it's how you present the case, as you rightly say.
Mm.
We never misrepresent. Let me just make that
Of
clear.
course, yeah.
It's just knowing where to go with your particular circumstance, where
Mm.
it's likely to be accepted first time round. Because what you don't want to do is a scattergun approach with lenders, because that just puts
On your
markers on your
credit
credit
file.
file, and it
Mm.
worries the next lender, saying, "Hang on, he's been there, been
Yeah,
to three lenders already. What was wrong with them?" Um,
yeah,
so it's a targeted approach. It's not going to waste your time. You're paying for a service after all, and good brokers don't charge until the job is done. We don't take
yeah.
anything up front. We only charge if we're successful. So we put the time and effort in,
Okay.
It's our loss if we don't get you the mortgage.
Yeah.
So guess who's going to work harder? The broker that
Of
takes money up
course.
front, or
Yeah.
the broker that takes the money on success.
Interesting. Yeah, very good. A final thing. So we've already talked about the fact that, it may be a good time for buyers to get. What's the market like for sellers? If I'm looking to sell my property, how does that affect me in this year, 2023?
I think sellers have to get a bit more realistic. I think Rightmove said prices had increased in January, which isn't the case really. It's asking prices, so that could be just agents overpricing just to get the
Mm.
property on the books. But I think
January is a historically a buoyant month anyway, so that could be why agents are overcharging. Yeah.
yeah, exactly. Yeah, it's competitive out there as well. So there's not much stock coming on. As we
Mm.
said earlier, people are just holding off selling their property.
Mm.
Uh, they know that they might not get the best price in the current climate, so they'll wait a
Yeah.
bit and see how things are. But I think as a seller, follow the tips, present the property well. Choose a good agent who knows the area, who's got some, buyers ready for you, hopefully,
Yeah.
and be reasonable. I think be flexible. Be prepared to take a lower offer in return for a solid buyer, because buyers being buyers can let you
Yeah.
down sometimes. So
And we're not saying it's necessarily like the worst time to sell, because we were just saying there that we think that property prices might dip by 5 odd%. So it's like, well, okay, if I'm selling a house, and I know you're talking about London, but let's just talk about the houses that we look at. Let's say I'm selling a house for £100,000, for example. It's like, cool, I might have to accept 95,000. How much is that realistically going to affect me? Well, if I bought it at 50 and I've already made a 50 grand gain, then maybe neither here nor there, or
mm,
100 to 200 or whatever it might be. So it's not the worst time for sellers, but like you said,
yeah,
in general, the rest of the market, the rest of the population are going, well, actually, listening to the news, it might not be the best idea to sell right now, so I'm holding
yeah,
off. That means that the number of properties on the market is lower, but that means that there's also ability, because of what we talked about at the beginning about the rates, the way that they are, the market the way it is, for us to get
mm,
involved, buy those properties, because it's only people that have to sell that will be selling probably. So get
yeah,
involved, buy those properties at the right prices, and then still rent them out, because in the long term, it's all going to work itself out.
yeah. I mean, 2023 will be a needs-based property market, because if you need to move, you're going to move.
Yeah.
And just if it's a residential property and you're buying the next one, it's all relative.
Yeah.
If you're having to give away £5,000 to sell your property, chances are the buyer that you're buying from will also
Give you a
move at a
£5,000
rate.
discount. Right.
Yeah.
Yeah.
So
Okay. Yeah.
when you're moving houses, it's all relative.
Yeah.
The people that need to maybe be a bit more careful are the investors who are not buying again, are
Mm.
coming out the market for whatever reason. They need to be careful that they maximize their gain. So
Mm. Yeah.
let's see. Mm,
Fantastic. So just to summarize then, what we're saying is that we think that in the long term, as in when I say long term, I actually mean in the medium term, in the next 2 to 3, 2 to 5 years, the interest rates are all going to level themselves out, probably back down to about 3% or something like that. As a
yeah.
result, and because property is a long-term game, if we take a long-term view, there is a good opportunity for us to buy right now, because everyone else isn't in the market. The prices
Mm,
are down and we can discount a little bit, especially during
mm,
2023. We will be able to negotiate more on the properties. And also, it would be better for us to be able to therefore buy multiple properties now, let's say with a mortgage, than for us to say, well,
mm,
let's actually just buy just one in cash. Because in the future, back to
mm.
say August, September, October, when everything starts to calm down a bit more, everyone else that's not in the market will get back into the market, and then the prices will go up again.
Absolutely, yeah. I mean, great profits are made in recessionary times, and
Mm.
if you can find motivated sellers, that's your ticket.
Perfect. Fantastic. And final thing then, Bob, what you're saying is that you think that if today's house prices say £100,000, you think that at the end of this year, are we going to be above or below, in December 31st, are we going to be above or below £100,000, or about the same?
We should be slightly below.
Okay.
It is still a tricky stage, tricky situation. We're not out of the woods quite yet.
Yeah.
But the inflation figures in the following and coming months will be a clearer indicator as
Perfect.
to how interest rates are going to go. And then the lower the rates get and the quicker they get lower, the quicker the market will start to recover. And the £100,000 house may be 95,
Yeah.
but it's unlikely to be 105.
Brilliant. So on that basis, then, if we can buy that £100,000 house for say 92 or 90, then we're doing well for ourselves anyway.
It's fine. Yeah, I think so.
Fantastic.
I think
Brilliant.
so.
Perfect. Thanks very much for the chat, Bob. Really appreciate it. And
Pleasure.
we'll speak again soon.
Thanks, Shiv.
Well done.